Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching Indian Open. Let's go straight to the headlines. 40 of 49 economists polled by Bloomberg expect the Monetary Policy Committee to raise interest rates by 25 basis points today. Petrol and diesel prices have gotten cheaper by as much as 5 rupees in BJP-ruled states after the centre cuts excise duty by 1.5 rupees per litre and asks oil marketing companies to absorb a rupee. States cut levies in tandem. With a maze of 348 entities, the IL&FS problem is significantly larger than previously thought, says the new board. LIC has announced an open offer to acquire 26% stake in IDBI Bank worth about 12,602 crores. And the global picture, sadly, is not looking all that great. We've been falling. We needed the global support. I don't think that's coming anytime soon, or at least it's not come overnight trade, because just look at the US markets and what they've done. They've all come off with the yields hitting those 2011 highs. I remember we were talking to Jeff Lewis yesterday about this. Now it's happening in the US markets too. NASDAQ down about 1.8%. Europe was a bit ho-hum as well, but essentially the mother market, which is the US markets, were down and down and out, and that's leading to some pain in the Asian screen in today's session as well. Without exception, almost all of the Asian markets are down. Hang Seng down about 0.7%, and SGX Nifty showing its hand as well. Looking at a downtick of about 0.5%. Let's see what happens there. Adding more fuel to the fire and something that could develop into a bigger piece. We don't quite know that, but I think the Bloomberg.com homepage has this feature story which speaks about how China used a tiny chip to infiltrate US companies. I urge you to go onto the Bloomberg website. It'll be there on BloombergQuint.com as well. But there's a lot of news flow out there about, issues between US and China. Now, as if the trade tensions were not enough, now we have one more piece of news as well that has come out, and that could add fuel to fire. Nothing as yet announced, or nothing as yet which could be detrimental in the immediate term, but it's something that will linger on the minds of global investors as well. However, our markets and the trade didn't look that great yesterday. And in fact, a lot of large caps. Yesterday, a number of people that I met, all of them said that yesterday was arguably the first day of panic of sorts, because Reliance Industries fell 7%. This is a mother stock of sorts, people, last point of hiding, etc. That stock came down 7%. And between these three names, HDFC Bank, TCS and Reliance Industries, almost half of the cuts that came into the Nifty yesterday, about nearly 140 points, was led by these three names. So not just concentrated selling, but heavyweight selling that came in a meaningful way. Fairly high short positions that are built on the indices as well. Nifty OI is up about 10%. That tells you about the quantum of short positions that are being built on the Nifty or the Nifty Bank as well. And keep in mind, if you look at the open interest distribution, 10,500 put option is the tallest bar out there. So a lot of positions built, and expect some unwinding of the 10,500 put positions if indeed the markets fall and continue to fall in today's session. That's the open interest distribution. As you can see, the tall red bar is the 10,500 put option. And if indeed the markets go down and stay down for today and maybe Monday, then you could expect some serious unwinding, which could put some technical pressure as well on the markets. The FI selling is not helping either. In yesterday's session, 2,760 crores sold by FIs. And we were talking about September being a bad month. October, the first 3 trading sessions, FIs have pulled out northwards of 6,000 crores. That's not chop change. So we're seeing the incessant selling by the FIs continue in the month of October as well, and that won't augur too well for markets at large, maybe for the currency as well. So expect some pressures out there to continue. However, there will be some stocks to monitor, aside of course, oil marketing companies and ONGC, which might be under pressure today as well. But there could be some other stocks which you should monitor. So Titan, they've given a Q2 update. They've said the growth in the jewelry business has picked up after softer Q1. There's strong growth momentum in the watch segment, which has continued as well. However, eyewear has shown muted growth this quarter. Eyewear is not that big a contributor. So when they're saying that jewelry business has picked up, suffice to say that Titan might just report good quarter, better than the one that they've recently seen. Jet Airways, they've gotten $35 million from the frequent flyer program as per the TOI, and actually official news releases as well that have come in. ICRA has downgraded this long-term rating to B from double B. The stock went up yesterday and day before, maybe in anticipation of the fuel price cut and maybe some benefits coming in to aviation companies as well. I could see the reason, but maybe this is one more reason as well. Let's wait and watch whether there is a bit of a pullback after 2 days of a rally that is coming to aviation stocks in general and Jet Airways in particular. Cadila Healthcare, the biologics managing facility at Ahmedabad, has received an EIR from the US FDA. Audit was completed with 0 Form 483 observations. Maybe this one could react. And Dilip Buildcon, well, now a bit of a forgotten stock in the infra space. It was talk of town really about 6 months back. They received a LOA for an EPC project worth about 600 odd crores. So do watch out for this one. But I dare say the morning too entirely will be about what's happening to oil marketing companies, what's happening to ONGC, and maybe some heavyweights like Reliance Industries as well. We will start off slightly lower today. However, what's lined up on First Word today is the collection of the top editorial stories that we believe we should bring to you. Is there a case for the Monetary Policy Committee to go beyond its inflation mandate? Ira Dugal pulls out the economic environment into perspective. Then, Sumit Sarkar takes a look at how the fuel price cut will hurt the oil marketing companies' finances. A detailed chat about that. With both crude oil and aluminum prices on the rise, Vedanta is in a sweet spot. Nikki Mirchandani tells us why. And then I dwell in a bit on whether the first 2 days of cuts on the IT space show cracks in the armor, or will they be resilient enough? Just put the numbers into perspective. However, the first one, and that's all about what happened from the RBI today. The tightening global liquidity, rising oil prices, and a widening current account deficit. Add to that the depreciating rupee. This is the economic backdrop against which the Monetary Policy Committee reviews interest rates today. Is there a case for the 6-member panel to step beyond its inflation mandate? Ira Dugal is standing by with the pulls and pressures that the MPC will have to consider.
The October meeting of the Monetary Policy Committee takes place against one of the most complex backdrops that we've seen in recent times. There's a whole host of things for the MPC to talk about. Inflation and growth, of course, which is their core mandate. The current account deficit, which is not its core mandate, but is a big problem for the Indian economy in this year and will feed into their core mandate. There's also, of course, the currency, which is hitting a record low a day. Liquidity has been tight and volatile, and credit markets are nervous. Some of this can be built into the MPC's rate decision, but some of it will actually have to be tackled by the Reserve Bank of India. Remember, MPC, RBI, two different bodies, and can take decisions which are complementary, hopefully. Let's start with inflation and growth. Now, remember, at the time of the August policy, the MPC had predicted that they will see inflation at about 4.8% in the second half of the year. Since then, you've had a couple of inflation readings which have been softer than expected, but most of that softness has perhaps come in from items like fruits and vegetables. So maybe the MPC would be justified in maintaining tight monetary policy just on the basis of its current forecast, which is that you would have inflation between 4.5% to 5% in the second half of the year. Remember, their band is 2 to 6%, but the last round of MPC minutes has suggested that most members want to try and anchor inflation closer to that midpoint of 4%. This is how things stood in August. Between August and October, there's been a whole lot of changes. In particular, if you look at the way the currency has moved and oil prices have moved, the rupee has weakened by another 7-odd%. Oil prices are up in double digits between the last two meetings. That's the August meeting and the October meetings. So obviously, the MPC would want to build in upside risks coming in from these two factors. A day ahead of the MPC meeting, the government did come in and cut excise duties on oil prices, asked states to bring down their taxes as well, and asked OMCs to bear a part of the burden. Some of that could reduce the inflation bite by about 15-odd basis points. So once again, that would need to be built in, but still, it may not change the MPC's mood on maintaining tight monetary policy. That tight monetary policy could come in the form of a 25 basis point hike, but it could also be accompanied by a change in stance away from neutral. We'll come to that in a minute. The complicating factor in all of this is the current account deficit. The expectation now is that you will have a current account deficit closer to 3% of GDP. That's the absolute red line. And in a year when we've seen capital outflows from the debt and equity markets of 66,000 crore, you have to A, try and keep that CAD in control, and B, try and fund that current account deficit through stronger capital flows. That's where the interest rate story gets complex, because it has been argued that interest rates must play a role in bringing down the current account deficit, which can also be seen as an imbalance of savings and investment. It can also be seen as excessive aggregate demand compared to supply domestically, and hence interest rates could play a role there as well. Interest rates can play a role also in drawing in more flows into the debt markets, but none of this is in the remit of the MPC because we now have an inflation targeting MPC. So what do? Well, they can try and see all of this through the lens of inflation because as Sajid Chinoy of JP Morgan pointed out, if there are imbalances in the economy, they will show up in inflation via at least core inflation. So maybe that's the lens that the MPC will use. As far as the money markets, the liquidity picture is concerned, this is more the RBI's issue and RBI's problem to solve. They've been doing that already. We've seen the liquidity deficit come off from a peak of more than 1.5 lakh crore, now actually fairly stable. So you'll probably see the RBI committing itself to active liquidity management in the second half of the year, and that the MPC will perhaps take comfort from. So you take it all together, where does that leave us in terms of interest rate decisions? Well, most economists are predicting a 25 basis point hike. Remember, that would be the third in the current year. The Bloomberg poll is reflecting that expectation, with 40 economists saying that a 25 basis point hike is likely. The more interesting question is that does it come along with a change in stance? Does the MPC finally move away from the neutral stance? And is there a slim possibility of a 50 basis point hike? There are some who are not ruling that out.
Well, let's wait and watch what happens there. Of course, we'll be there with the credit policy coverage from 2:15 p.m. onwards, right here on Bloomberg Queen Live. The next piece, and arguably a very important piece from a market's perspective, the centre has decided to cut excise duty on petrol and diesel. It's also asked all marketing companies to absorb a 1 rupee cut, bringing down prices by at least 2.5 rupees across the country. And if you lived in a BJP-ruled state, chances are that you will be saving a total of 5 rupees per litre, with the states also cutting taxes in quick succession. While the government maintains that it is not going to hurt its finances, the same can't be said about the oil marketing companies. Somit is here to give us a fact check. Somit.
So a couple of changes that happened yesterday. First, the excise duty was cut by around 1.5 rupees. And if you see the petrol prices in Delhi, as of 1st October that we had the price build up, you can see here that the excise duty on 1st October was around 19.48, which will now come down to around 17.98. That is a cut of around 1.5 rupees. And also the gross marketing margin. Now that will come down for the oil marketing companies because they have been asked to bear that 1 rupee impact. So as you can see here, the gross marketing margin will come down to around to 41.79 from 42.79 that was there earlier. So this is that 1 rupee impact that they will bear on petrol prices. And if you see the diesel prices, now on diesel prices, you can see the excise duty will come down from 15.33 rupees to 13.83 rupees, and their charges will come down from 46.22 to 45.22. So that's the 1 rupee impact. Now this cut in the gross marketing margin that the oil marketing companies will take will bring down their gross marketing margin to a 5-month low. It will come down to around 1.4 rupees on diesel and 0.7 rupees on petrol. Now similar kind of margin was seen during the Gujarat elections, that was in December 2017, and during the Karnataka elections period, that was in May and June. So that is not something new. We have seen this kind of lower gross marketing margins earlier also for oil marketing companies. So why did they react that negatively yesterday? Because if you see for the next 7 or 8 months, there are at least 9 state elections and general elections. And if the gross marketing margins remain at such a low point, that is 1.4 and 0.7, this could further fall going forward because the crude is expected to be at an elevated level. And given the history that we have seen during the election period, that there is a restricted rise in the fuel prices, this gross marketing margin could further fall for the oil marketing companies, and that's the reason the investor sentiments for this oil marketing companies have now become negative.
Between the three, Somit, which one gets impacted more? Have you been able to decipher that?
Well, it will impact HPCL the most because the marketing segment contributes nearly 61% to the company's EBITDA. Now, this 61% is not only related to petrol and diesel, but to other petroleum products like ATF, naphtha, but petrol and diesel form the major part. So you can see HPCL, it gets nearly 61% of their EBITDA from the marketing segment, while BPCL and Indian Oil Corporation, now they are much more diversified, and marketing segment contributes only 19% to IOC, and for BPCL it's around 39%. And if you go by Kotak Securities note, now they said that a 0.5 rupees cut in the marketing margin would bring down the earnings per share for the oil marketing companies by 12 to 21%. You can see that 21% EPS impact for HPCL if the marketing margin comes down by 0.5. So a 1 rupee cut would double this impact on the EPS for all the oil marketing companies. So that's a negative impact on the earnings of the oil marketing companies. And if you see, now there are a couple of positive things that have come out from this news. So first is that there could be a market share grab that these state-owned oil marketing companies would see. Now private sector and petrol have around 6.9% market share. Now it's very highly unlikely that these private players will take that 1 rupee impact, because they have not been asked to, and taking that 1 rupee impact will definitely see a negative impact on their margins. So there's a possibility that they might not take this impact. So this market share grab would be up for these oil marketing companies. And diesel, there's an 8.2% market share. So we'll have to see how that pans out. But it would not be a much bigger impact, because the market share is very low for the private companies. And along with this, we have also seen around 12 BJP states come out with VAT cuts. So that could be a positive point for these oil marketing companies, because it will give them more room to increase their prices going forward. But we'll have to see how that pans out for all the oil marketing companies going forward.
Okay, interesting. If we can, and Sumit, I just wanted to go back to the chart where Kotak Securities is talking about the EPS cut or the earnings cut that comes in because of the 0.5 rupees per litre cut. Yeah, this is the one. So are you saying that because of the 1 rupee cut, the EPS of an HPCL, as per Kotak, would therefore mean that EPS for HPCL could come down by what, 42%?
Yes, that's what the Kotak note said.
Very interesting. Despite the fact that marketing is one piece of the business, the other two pieces of the business notwithstanding.
Yeah, but for HPCL, if you see, 61% of their EBITDA was from marketing segment. So that's a higher impact for HPCL.
Wow. Okay. Well, no wonder. So there is some math to the madness, and there is sentiment to the madness as well, as Sumit was explaining. Two pieces, I think. One is the number of state elections that come in, and two, whether the market sees this as the first sign of intervention in a space that was hitherto not intervened in. Sumit, thanks for putting that into perspective. Really, really appreciate. Remember, all marketing companies clearly have to bear some of the burden, and there are fears of even the explorers being roped in, but none of these concerns apply to the private commodity giant Vedanta, because the oil to metals producer stands tall amidst the ongoing market correction. Nikki Mirchandani is standing by to tell us what could be lending strength to the company. Now, Nikki, Vedanta has a lot to cheer about, doesn't it?
Yeah, clearly, on a one-month basis, the stock has outperformed most of its metal counterparts on the Nifty Metal Index. In fact, it's one of the three stocks that have done well or done positively so far in this 1 month. Outperformed most of them. The only, barring the performance that we've seen of Hindalco. Now, Hindalco and Vedanta both have fetched return in the range of around 6.5–7%. But for Vedanta, what's really going well? The soaring crude as well as the aluminium prices, the main contributors towards the EBITDA performance of the company. The prices of that commodities are rising. Apart from that, you have the expansion across the segments that the company has outlaid. So in those divisions particularly, we're expecting higher EBITDA growth. Talking about that, I'm going to be highlighting FY18 EBITDA mix for the company, where the oil and gas, zinc and aluminium business, they're the key contributors to the EBITDA growth, contributing to around 22%. For oil and gas, zinc would be around 46%, and for aluminium division, that's around 12% of your overall FY18 EBITDA growth. That is expected, that mix is expected to change for oil and gas from 22 expected to go to 32% in FY19. For zinc, India is expected to be increasing, it's actually expected to be decreasing from 52% to around 48% in FY19, and for aluminium, it's expected to increase from 12% to 14% 5%. Talking about aluminium prices, they've risen as much as 5% in the last 1 month odd. And if you look at the 3-month performance, that's a 14% uptick there. Shutdown of a major alumina refinery in Brazil. Apart from that, you also have the sanction against Oswal, the major maker of aluminum, which is the key raw material for aluminum, which have actually led to the uptick. Also, the Brent crude prices, they're also on the boil. If you look at the 1-month performance there, we're looking at a 12% uptick there. Decline in Iranian exports and uncertainty of ability of other major oil producers are expected. The concerns around that have led to a rally in the Brent crude prices, which definitely augurs well for Vedanta, given these two segments contribute more than 50% of the EBITDA performance, which is further expected to go higher in FY19 as per the Goldman Sachs report. Also, if you look at the expansion across the segments that the company has outlaid in the investor presentation, for zinc, it's expected to go up by 25% from FY18 to FY22. For Zinc International, it's almost expected to double out there. For aluminium, it's expected to rise as much as 35%, and for oil division, it's expected to move up to higher by as much as 41% to 186 KB OPD as compared to 262 that we are estimating in FY22.
Nikki, thanks for putting that into perspective, and thanks for joining in today. So that's Vedanta, and yep, it's been one of those stocks that has managed to weather the storm a bit better. The 1-month return of 4% compared to almost any of the other names, and you would find that that stock has done well. In fact, if you compare it to IT as well, probably is done well. That's one sector. Remember, now, we're talking about points to hide or places to hide in. Does IT give you that advantage? That's the question that dwell on, the positives and the negatives. It's held on in an otherwise weak market in the year thus far, that is technology. The picture is slightly different though this week, with the benchmark index showing some signs of joining the bandwagon to trade lower. So is this a sign of the cookie crumbling? Let's try and figure that out. Now, first, if you just look at what the sell side estimates are for Nifty IT or any of the large cap IT names. This is the Bloomberg consensus 12-month target prices where they are, and you will see a clutch of names, save for TCS as well as Wipro, still having some upsides. These numbers will change very rapidly once the results start coming in next week onwards, but thus far, this is what the return potential looks like, which is not bad in a scenario like this. What's working for IT? Let me dwell on that first before I bring out what could not be working. Now, the weakening rupee means better operational margins and better bargaining power versus global peers. There is confident commentary coming in from companies like TCS and a few others. Infosys growth over margin strategy under Parekh seems to be working according to a lot of analysts. Wipro has won a lot of large deals in the recent past. I think this last 3 months I've seen number of flashes and a number of announcements about Wipro winning a deal post another, and which means it's getting past some client insolvencies that it was plagued with in the past as well. HCL Technologies at the upper end of their guidance has guided to a double-digit growth as well, and there is accelerated digital services growth for Tech Mahindra. So you would ask, well, if all of this is happening, why is it that the market might be skeptical? Well, there are 2 or 3 reasons. One is the valuations. Just first take a look at what the stocks have done YTD and in the last couple of days, and you will see the difference. The stocks have run up and run up quite a bit. This is the Nifty IT return chart for the last 1 year or the other, the YTD returns, and you will see a lot of green and very little red. So YTD Nifty IT is up about 32% and save for Infibeam, which you can understand why, almost all the other stocks have gained. Now, I've just used 2 examples to illustrate what's happened to valuations, but bring up the P multiples of TCS and Infosys, and you will see what I'm talking about. Compare these numbers to the last few years, and you will see that these stocks are trading at substantially higher P multiples. For TCS, the numbers go as back as 2011. We've seen that little bit of a fall. These are the price earning multiple charts for TCS and Infosys. TCS is the white line, Infosys is the blue line. You will see that little bit of a dip in the last couple of days, but otherwise the valuations have trended way higher at 25 times. Never mind the safety, TCS is not a cheap stock. Neither is Infosys, with the kind of flux in the management and the kind of operational picture that it is pointing towards versus TCS as well. And for the others too, Wipro, for example, I think the valuation multiples way higher than what they have been in the recent past. So the question mark only is that after the run-up that we've seen, are these stocks already pricing in the highest possible growth rates that one could expect from these stocks in the current year? Because nobody's looking at FY20 right now, to be honest. So that may be the first sign of pressure that is coming in. You don't often hear voices like Morgan Stanley going out and saying that let's book profits in the IT names because they've run up quite a bit. Morgan Stanley's done that, a few other companies have done that, or a few other brokerages have done that. And it's showing in the way the stocks are performing. Just one final chart, if you just look at the supports that Nifty IT is taken, and I think this would be a key thing. Can Nifty IT find support at that 50-day moving average from a technical perspective? All through the last 18 to 24 months, at various instances, the pink line on the screen is the support line, the 50-day moving average where Nifty IT has taken support. It's now closing into those levels. Can it find support at these levels? That's the question that you got to ask. Well, time will tell. The next few days will certainly tell. That brings us to the end of First Word, but a lot more lined up on Indian Open. We speak to Gautam Chhaochharia of UBS about how should one approach the markets during the ongoing correction. And we discuss the monetary policy expectations with Taimur Baig of DBS Group. But after this break, a full tilt towards the day's trade.
अमीर थी ये धरती फिर भी गरीब थे हम लोग उगाते थे चावल फिर भी भूखे थे हम लोग ना रास्ते थे ना मंजिल की थी आस खड़े थे दुश्मन बंदूकों के साथ था बीमारू बस अपना ही नाम यही थी अपनी पहचान हाँ यही थी अपनी पहचान
लेकिन भैया ये तो 15 साल पहले की बात है पर
आज नाम है हुनर से काम है ऊंची उड़ान है नई पहचान है विकास का इतिहास है हमें रमन पर विश्वास है छत्तीसगढ़ खुशहाल है स्वर्णिम भविष्य की आस है
Good news, got a promotion and a damn good raise.
Congrats बेटा।
वाह रेज अब तो इंश्योरेंस पॉलिसी ले ले।
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा।
That's good, but आज की जनरेशन wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना, same choice. LIC.
LIC trending with times. 62 सालों से हर जनरेशन की पसंद।
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. You know, if you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. coming. Product of the year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture $1 billion.
RP Sanjeev Goenka Group, growing legacies.
Good morning to all our viewers. You're watching Indian Open right here on Bloomberg Quint. It's been an exciting week and we're wrapping it up this Friday morning. Let's quickly tell you what's stacked up as we start off a trade at 9:15 in terms of the Asian market setup. Looks tough. So it's, a tough week which is rounding up with further losses for the Asian markets. The Nikkei 225 down about 1%. Hang Seng is down about 0.5%. Remember, Chinese markets are shut, but this is trailing the losses that's coming in from the US equity markets, which are now at 3-week lows in the back of what's been happening to the bond yields. So S&P 500 shut shop about 0.8% lower, followed by some losses in the Nasdaq as well, down 1.8%. On the SGX Nifty, we're trading lower once again, so not as sharp as yesterday, but still down about 0.5%. 10,560 is the cue that we're getting from SGX Nifty. For our market, in terms of the setup and the futures and options, segment, the build-up was pretty strong on the Nifty as well as the Bank Nifty, particularly new shots coming into the system. We've got Darshan joining in right now to take us to the entire wrap-up of what's buzzing in that space, Darshan.
Yeah, so basically, if you're looking at it, it's been a weak session, a weak week, and mainly of the losses came in on account of the oil marketing companies and the oil stocks. Now, if you're looking at it, yesterday the Nifty saw fresh shorts, open interest build up of 10% on the short side. The SGX Nifty is indicating a gap down opening. It's come off the lows of the day. It was down 90 points at one point of time, now down 45 points. But nevertheless, that will wane on the Nifty itself. So that's the trend that we're seeing. The Bank Nifty didn't see so much of a cut, mainly on account of two reasons. The Nifty had the entire oil marketing company and Reliance and TCS, which have a larger weight. The Nifty Bank, ICICI Bank did well, Axis Bank did well, a couple of PSU banks did well, so they have high weightages on the Nifty Bank, and that is why Nifty Bank saw long unwinding that came in. Now, if you're looking at where positions are being built, this is the India Wix. The India Wix now coming to levels of almost close to 19, so that's the trend which indicates that the move pretty much will be on a larger scale. Now, what we're seeing over the past few days, and this is the total open interest at this point of time, the shift has shifted, the support has shifted from 11,000 in the last series to 10,500 at this point of time. 44 lakh shares is the total open interest at this point of time. We are anywhere between 10,500 and 10,600 on the SGX Nifty, and that is pretty much where the Nifty will open. But look at here, 10,700, 10,800 and even 11,000 levels have outstanding put writing that is happening, which pretty much will square off, and there will be more selling that comes in if the Nifty manages to stay at this level or goes below the 10,700 level. But the other thing I want to point out is 10,600, 700, 800 call writers haven't been that aggressive, which gives an indication that they are anticipating a pretty much amount of technical bounce back that could come in. So that's the setup at this point of time. It's tricky at this point of time. In terms of open interest change, what we're looking at is call writers became aggressive from levels of 10,700 to higher levels in trade yesterday, and put writers were forced to shut positions as premiums went up and they were booking losses there. The Nifty PCR came down significantly from 1.36 to 1.82. The Bank Nifty PCR pretty much stayed stable. A couple of stocks that I want to point out. The first one was BPCL. Open interest build up was 30% on the short side. All the oil marketing companies look rather weak, closed at the lowest point of the day, and with the downgrades that come in, pretty much could see selling pressure in trade today. Marico, FMCG as a pack is seeing fresh shorts. This one saw fresh shorts on high open interest build up of 11%. On the negative side, so watch out for this counter. Reliance also, the impact is clearly there. 4% open interest build up was low, but a counter like Reliance cracking 7% is a matter of concern. And the final stock that I want to point out is Interglobe Aviation. Yesterday saw fresh shorts on low open interest build up. Yesterday, Jet and Interglobe, both of them moved up significantly on the anticipation of the fuel price hike cut. They came off the days of a high, but nevertheless ended with a positive bias.
All right, Darshan, thanks very much for that. So precariously placed in terms of the kind of pricing activity and open interest activities for some of those stocks there. Let me bring in Girish Pai at this point. He's the head of research at Nirmal Institutional Equities. He's joining us on the show right now. Girish, good morning to you. And I'm going to straight off start off with the big news of yesterday and what the government did with the oil marketing companies and what the announcement means for them. Because the threat is now become that much more real in terms of the earnings downgrades, the kind of EPS impact that you'll see for most of these oil marketing companies.
Yeah, so to start off, I would say that we've been negative on the oil marketing sector for a fair bit of time, almost like for 1.5 years, and for different reasons. Our reasons were to do with the fact that these companies were going into a capex cycle, which would lead to debt going up, interest costs going up, depreciation going up. Therefore, the very good environment they had from an earnings perspective prior to FY17, there was an earnings CAGR of about 35% positive, would see a kind of cut going forward. But having said that, what's happened in the last, I would say, 6 to 8 months, the market has had apprehensions about the way the crude has moved and where the rupee has moved and what impact that would have on the financials of the oil marketing companies, and that's kind of played out. In fact, we've been surprised that the stocks have kind of held up until yesterday. The fact that they've been fairly strong in the kind of environment, crude environment we had. So I think it's natural that the government has followed its political instincts. There is the pre-elections coming up, and obviously they had to make this announcement before the election dates are announced. So I think what it does, obviously there is a cut of anywhere between 25 to 50% on the earnings of some of these companies. We will have to downgrade our numbers, our target prices, etc. But having said that, I think the key worry now is whether prices will be frozen, because we did have that previously, or would they be let free in the sense that with the 5 rupee cut that has happened for these prices in various states, will these OMCs be allowed to increase prices as crude moves up and rupee moves up? Or rather rupee depreciates. If that happens, that's a mild positive is what I would say. But otherwise, obviously there is this overhang which is there on these companies, which could lead to, I would think, a derating. There is this impact on earnings, but I think people are valuing this more from a price to book multiple perspective. The price to book multiples had moved up from sub 1 times to almost like 1.7 to 2 times when they were in good territory. I think they've kind of moved back now. Maybe they will traverse towards that 1.25 times price to book multiple over a period of time if the market believes that this is a permanent situation. One of the interesting things that Mr. Jaitley said was that this is not a rollback of deregulation. Now we need to see whether that kind of continue, whether he actually carries that forward in the sense that post the elections will there be some kind of measure from the government side to actually remunerate these OMCs. So I don't know. It's a bit of an iffy situation. Right now there is an overhang. I would think, I think a lot of funds have taken fairly large bets on this stock. So to that extent, there could be further pressure is the way I see it. I think maybe closer to 1 times book could be the time when I would probably want to look at these stocks at this point in time.
So they are what, 25% away from those 1-time book levels? 25%?
Could be, maybe I think slightly higher.
Slightly higher.
Higher could be what I would think.
Does this expose ONGC now, they were sort of cushioning themselves from the fact, and the government came before saying that no, we won't ask them to share subsidy, but they themselves have not changed their own subsidy targets. So
yeah, so I think if you go back in history, we had a 3-way under recovery sharing mechanism, in the sense that you had government taking 1/3 share, the upstream companies taking 1/3 share, and the OMCs taking 1/3 share. We could potentially go back to that kind of a situation. So it's not that you can move from OMCs to the upstream companies. I'm talking the PSU upstream companies here. So there could be that little bit of threat on ONGC also going forward if crude continues to move up. There is talk of it moving to $100 and stuff like that. I mean, I don't know.
Guess,
it's anybody's guess as to how that's going to kind of play out.
Yeah, but so what this does to ONGC is one thing as well. And of course, yesterday, I think the texture of the market and the sentiment got damaged because the big boy, Reliance Industries, after some time fell meaningfully as well. Too much of oil and gas conversation, I know, Girish, but what happens out there?
See, we really don't track Reliance, so I will not be able to comment on it specifically. But I think that if you look at last 2-3 days, we've seen a situation where some of the large caps which are holding the market up, Reliance, TCS, Infosys, and some of these large caps have kind of cracked, which give me a sense that some of the FIIs who've been long-term holders of these kind of companies are kind of selling out. Maybe it's to do with pressure in emerging markets specifically, and with the way rupee is moved, the dollar returns are kind of hurting them in one sense, and probably they don't want to face further pressure on that side. Probably that's kind of, see, I think everybody, the fund managers have this 1-year window to show returns. It's not that they can take 5, they don't have the luxury of taking a 5-year call. So somewhere down the road, they're going to be looked at, measured from a 1-year performance perspective, and they would want to protect whatever returns they've made thus far. So Reliance has given phenomenal returns over the last 12 months, or probably even higher than that from a time frame perspective, and probably they would want to kind of take money home in one sense. Is the way I will look at the way Reliance is moved.
Yeah, and I was saying for talking about IT in a bit, we'll do that as well, because Girish had some fabulous calls to make on that IT space as well. But it's time for getting in our research team to speak about all the key stocks in news and movers as well. So let me go across to our research huddle and get in Nikki, Shraddha, as well as Saloni, the same trio of yesterday, to talk about all the key news makers. Shraddha, this time I know you're going to talk about stocks in news, a bunch of them, Titan included, which have come out with some announcements. But what's the list looking like?
That's correct. So I have 4 stocks on my list. IDBI Bank, where LIC has made an open offer for 26% stake. The price is 61.73 per share. That's a 8 to 9% premium to yesterday's closing price. You have Jet Airways, which has received about 258 crores from Jet Privilege for advanced ticket sale. That's according to a PTI report. So at least some sort of cash infusion coming in. Jet Airways additionally has said that ICRA has downgraded the long-term rating from BB to B. Dilip Bilkon, which has received a LOA for an EPC project worth 601 crores. A lot of order wins these days coming in for Dilip Bilkon. And finally, United Spirits, which has said that the top courts highway ban and GST has disrupted the industry. More importantly, they will need to repay debt by disposing of some assets. And of course, Goa Carbon reports numbers today. So start of earnings season.
Start of earnings season, yeah, let's look at it that way. Thanks a lot for that, Shraddha. In some ways, some of the companies that already started off. We had Saloni speak about HDFC yesterday, and now Nikki talking about Titan, I presume.
Yeah, so it's a business update for Q2, where it's a good show for the company. If you look at the jewelry performance, it's a good Q2 as compared to the muted Q1 that we saw, mainly aided by the activation. And if you look at the number of stores, 6 Tanishq stores have been added for this quarter. With that, HSBC estimates a 22% revenue growth for second quarter in the jewelry segment. What segment? Good show continues in Q2. Witnesses growth across the channels. Eyewear, it's a relatively muted quarter out there due to the activation that we've seen in the corresponding quarter of the previous year. In terms of the stores that have been added, we've seen maximum number of stores being added for the watches division, maximum number of stores being closed for watches division. And in terms of the retail space addition, there the jewelry segment has seen the maximum addition out there. Even if you look at the revenue mix, it's the watches and the eyewear, it is the watches and the jewelry segment which contributes to the majority of your revenue, as per what we've seen in Q1 FY19. HSBC remains upbeat on Titan. It has retained the buy rating and the target price of around 1,050, which indicates a potential upside of more than 35%. Says that Q2 numbers have ensured and to an extent have assuaged fears that FY19 guidance would be met by the company. We're expecting, the brokerage is expecting a strong Q3 on account of the low base, and also in terms of the valuation, it feels valuations right now are attractive given the kind of correction that the stock has seen in the recent past, and it feels that the strong earning momentum could be a key catalyst for the company going forward.
Well, let's wait and watch what happens to Titan in an otherwise dull market. Remember, there's SGX Nifty indicating a downside of 0.5%. But in a scenario like this, there is an extremely bullish note on Delta Corp, Saloni.
So UBS has initiated coverage on Delta Corp. They remain extremely bullish on the stock. They see an upside potential of nearly 50% from the current market levels with a target price of approximately 310 rupees. They believe that Delta Corp, which is India's only listed casino operator and a market leader in the country, has multiple growth drivers that are still not priced in, which includes rising popularity of Goa and casinos, increasing traffic for its leading poker site, that is Adda52.com. A high option value from obtaining a casino license in Daman will be a key positive for the stock. Also, increasing traction for the Sikkim casino will make an attractive bet for the stock in the near term. They believe that Goa government's new casino policy, which is likely to be implemented this year, will act as a catalyst for Delta's share price as well. They believe that market is still not pricing the growth opportunity in the stock, and hence they expect earnings to grow at a CAGR of nearly 27% in next 2 years. They also mentioned that currently the stock trades at a 20% discount to its 3-year average price to earnings ratio. So let's see how the stock reacts today.
Yeah, well, let's see. Thanks a lot for that, Saloni. So, well, bullish note on a mid-cap name. Interesting one out there. Nevertheless, I mean, from a clutch of stocks, Girish, since from the stocks in news list, I thought Titan stood out. Just wondering, the stock, again, higher P multiples and other reasons bringing the stock down over the last 2 or 3 months. But a positive update. Do you guys have Titan within your coverage?
No, we do not cover Titan.
Okay. Any thoughts on that broader consumption space as well? Because that is, in a manner of speaking, the last man standing of sorts.
Yeah, I think on consumption, we need to kind of pair our earnings estimates as well as P multiple, target P multiples, because I think what's happened in the last few months is a situation where if you look at discretionary consumption, if you look at auto, for instance, the numbers have kind of disappointed us a bit. So my sense is there is kind of a bit of a pullback that one is seeing in demand on the consumption side. I think over the last 6 to 9, 12 months, we've been talking about a deteriorating macro, whereas a micro has been kind of fairly strong, where earnings picture is looking fairly good. And part of that earnings picture has been this consumption growth, which has been fairly strong. I think my sense is while the macro is deteriorating at a faster pace, I would think that there is probably some damage to the micro too. I think earnings will feel some bit of an impact. We see that from the auto numbers. We could potentially see that from some of the other consumer names also. So my sense is that the earnings have to be paid a bit. The other big part of the the price picture is PE multiple. I think PE multiple has to be paid because the way cost of capital has kind of moved up. My sense is that that also has to change. So as we look at our portfolio, I mean, if I look at these stocks that we cover, there are a lot of consumer stocks where there is like 50-60% upside from where they are currently. I mean, some of them have corrected pretty dramatically. So we need to probably recalibrate our earnings a bit, more so the PE multiple. So that's something that we need to kind of watch out for. But I'm very comfortable with most of the stocks we cover under the consumption space from a multi-up standpoint. I think these are great franchises. So this could be a point to get in, but have a much longer time horizon to hold on to for some of these kind of returns to kind of accrue to you. So don't expect a quick return. There could be a bounce back. I mean, it's very difficult to call the market, but my sense is that these are good franchises. You can get into them and hold on to them for a fair bit of time, and they're going to probably give you returns at least as good as the market is going to give you.
Girish, just want your opinion. At this juncture, is it prudent to sit on cash, waiting for the right opportunity? Because, I mean, the way we're placed, the market structure looks a little bit weak. I mean, downsides, probably at this juncture can't pinpoint and say we're bottoming out and start, bottom fishing or looking for value in stocks. But does it make, is it prudence to sit on cash?
See, it depends on who you are.
A retail investor.
Yeah. So if you're a retail investor putting in money into SIPs, into mutual funds, I would say this is a very good time to invest and hold on to your existing or continue to invest in SIPs, because it's through these down phases of the market that for the amount of money you put in, you're going to get more mutual fund units, which is actually going to be good in the long term. So I would think that for a very long term SIP investor, these kind of phases are what are going to be good for them. So don't get out of your SIPs, continue to invest in them, don't redeem your SIPs is what I would probably say. For a institutional investor or for a normal direct investor, I think you need to have a fairly long-term horizon from here on, because I think if I step back and look at the entire bull market cycle, I think we probably at the fag end of the bull phase is the way I would look at it. In the sense that if this is a five-day test match, we probably post-lunch session is what I would say we are at right now.
Day one.
Five-day test match for fifth day post-lunch. Okay. Fifth day post-lunch is fifth day post-lunch is what I would think we are at right now. So I would think that's where we are. And if you're going to hold on to stocks, if you're going to buy anything right now, you need to probably sit through some of the volatility we're going to see in this bull. So stocks are headed higher, but they're going to be intermittent corrections. So one of the things that we keep this, I mean, there's a lot of chatter about this very strong correction we've seen, but it's actually garden variety correction. If you look back in history in bull markets, it's a 10% correction on the index. If you look back in the 2003 to 2007 bull market, every year you would have at least 2 or 3 corrections which are 15 to 20%. And I've seen the 2004 correction, which was massive when NDA 1 lost power. So
10% in a day.
I mean, the market continued to power on. I mean, despite all that happened. So I would say that, yes, obviously below the index there is a lot of damage that's happened, but should also look at the fact that over the last 3-4 years, that part of the market has delivered you phenomenal returns. There's been like huge amount of PE multiple expansion that has happened in the mid cap to small cap space, which is getting corrected because of cost of capital moving up. So, and also this whole SEBI reclassification issue which kind of played out. So I would say yes. So if you're buying equities directly right now, as an investor, you need to have a much longer time horizon in mind, is the way I would look at it.
Okay, before we move further and talk about IT, we will talk to Girish Pai about IT as well. It's time for our special segment, Bloomberg Edge, wherein Yash Upadhyay tells us a pattern that the Bloomberg terminal has thrown up on a stock. Yash, what's the stock on your radar today?
Well, another sell signal is generated by the Bloomberg terminal, and this time around, it's ONGC on the charts. It has snapped this 3-day winning streak to end yesterday with losses of almost 10%. And with this, the trender indicator has turned red, indicating a sell signal. But before going further, let's try and understand what the trender indicator is. It is basically a momentum indicator which uses the average 2 range for its calculation and generates a buy and a sell signal. How do you interpret it? It's very simple. When the trender line turns green, it indicates a buy signal, and when the trender line flips to red color, it indicates a sell signal. How does it happen? Let's look at the chart first. With yesterday's move, the rightmost candle over here closed below the green line of the trender indicator, and with that, it means that the trender indicator has now turned red. For it to turn red, the candle has to end the day below the indicator line, which by the way is what the indicator is suggesting. And in the last 1 year, every time that the indicator has flipped red, the stock has managed to go down by as much as 10% from the current levels.
All right, Yash, thanks very much for that. So that's Bloomberg Edge for you. Girish, we'll come down to those specific sectors, but since you were talking about the broader market, the market investing strategy seems to have changed from last year, because last year the stocks, at least for calendar year 17, the stocks that gave you maximum returns were stocks with market caps of 5,000 and below. I mean, the mid cap and the small cap space, which sort of stood out, ROEs of about 11 or 12%. Those were the kind of stocks that were getting maximum returns, while the top quality names with the ROEs of more than 20, 21 odd, they didn't stand in the stack. This time around, so far, we've flipped the coin, and looks like the investment strategy has diverted towards the quality names versus the smaller ones, which give you those elevated returns.
Yeah, so I think a couple of points here. One is that while those stocks kept moving up, that was largely driven by a PE multiple expansion that happened for these smaller cap stocks. Obviously, it went into territory which were unsustainable in some sense. So I think beginning of this year, when SEBI kind of indicated that there has to be a reclassification of mutual funds, and so the amount of money that a mutual fund could put in the mid cap and small cap stock got constrained. I think the incremental institutional buyer kind of got sidelined in one sense. So the key supporter of some of the quality mid caps and small caps kind of stepped back. I think that was one of the key issues that particular space is facing. Obviously, with cost of capital going up and a lot of other raw material prices going up, the smaller companies are much more vulnerable to margin compressions because of some of these issues. So I would think that if there's an adverse fundamental situation kind of arising, I would probably think that the smaller companies, the earnings are going to be more volatile. And obviously, as I said, the cost of capital moving up is going to impact them. So I think you need to go stock by stock basis. If you want to buy a particular company, you need to look at a high quality stock which has got a good franchise in a good sector, good return ratios, good runway. If you have a 5, 7, 10-year kind of runway of growth of 15-20%, good return ratios, those are the kind of stocks, even if they are trading at slightly higher PE multiples, I would go out and buy them even at this stage. So that's the kind of franchise I would look at of buying and sitting on. Yes, I mean, they also could potentially see cuts even going forward. Maybe a 20-30% cut can potentially come through for some of those companies also. But I would be comfortable sitting on them if I take a 5-year view, is broadly the call I would take.
At some point of time, Girish, in the show, we'll urge you to probably share some of those things as well. I mean, not necessarily an idea right now. Keep that at the back of your mind. None of the ideas that are discussed on any platform are for the here and now, to be honest, because nobody knows how far the damage would be. But let's try and get in Gautam Bisa of LKP to talk about what the near term could look like. He's joining us on the show to talk about the derivative space. Gautam, good morning, and thank you so much for joining in and accommodating this last-minute request. How are you reading into the trade, Gautam? Is there more immediate downside? What kind of trades would you take, either on the Nifty or the Nifty Bank?
Good morning. In last few of the conversation that we have had, I had mentioned that it's more about the technical aspect that has been playing out in the markets. A bearish engulfing and monthly charts should not just hold for 100-200 points, and we have seen from 11,000, 11,050, we are almost created 500 odd points. There's a possibility we may see some more pressure going ahead. I don't think it's going to be as severe as what we saw yesterday and day before at 400 points wiped off in a day or two. But as the overall fabric of the market is going to be weak, Nifty has finally closed below the 200 DMA, and that too by a significant margin, significant volumes. And the mid-cap index has also seen good amount of pressure. Bank Nifty has been under pressure. There can be a bounce back, a technical bounce back. Nifty is in the oversold zone on very short-term charts. So a technical bounce back cannot be ruled out. But as long as we do not close about 10,750, one should not be trying to pinpoint where the bottoms are going to be made. It is going to be a sell and rise market for timing. So for me right now, any jump towards the level of 10,700 would be a selling opportunity for target price of 10,500, 10,400. 10,400 is the immediate trend line support that we are seeing on the weekly as well as monthly charts. Below that, it can even slip to lower levels. That I would not like to talk about right now. For first thing first, 10,400, 10,450 is what Nifty can go to. Sell and rise market for time being.
Sell on rise market, that's Gautam Bisa's view on the index. We'll go and take his stock ideas in just a few moments. But joining us also on the show is Rahul Shah. He's the Vice President for Equity Advisory Group at Motilal Oswal Securities. Rahul, good morning to you. What's the take on the indices now? Are you also of the camp that a sell on rise strategy is prudent at this point?
Hi, good morning. I think what we've been seeing is consistently sell-off, and yesterday's sell-off, if we see that interestingly all large cap participated in a big way. So basically all index heavyweights falling 3 to 4%. So my sense is one thing is very clear that we will see on upside limit seems to be a cap in indices. But interestingly, if you look at it, the puts which got cut and which the fresh position which has been built from 10,800 to 10,500. So my sense is that 10,500 should hold a good support for a near term. At least that's what I believe for next 3-4 session. So in that perspective, yes, the upside could be I think 10,650 or 700 odds on a Nifty front, but I think 10,500 should hold. That's what I believe.
Rahul, we can run through your stock ideas as well.
Stocks, I think two stock ideas. One from obviously banking space. I think private sector banks we've seen sell-off continues. I think on top of the mind which comes is, I think which is showing the weakness for quite some time is IndianOpen Bank. So I think this stock from 20 to 2050 has been consistently falling, and it's yesterday it made an attempt to go up, but I think it's continuously, I think, the shorts built up in the stock, and technically also stocks look more weakness on the charts as well. So I think I would go short on IndianOpen Bank with a stop loss of 1630 and target of 1540. Second idea is from the metal space. I think yesterday, in spite of a good sell-off, we saw metal stock resilient very well, and in that space, I think Tata Steel looks good. So I think 570 is a major support for the Tata Steel from the current level. So I would buy Tata Steel with a stop loss of 570 and target of 610.
All right.
Now, and we'll talk about the Nifty Bank put option in a bit, but Gaurav Bisa, your stock-specific ideas, very quickly.
The first recommendation would be buy on UltraTech Cement. The stock had seen good amount of correction, bounce back from the 5-year channel support. Good amount of short covering has been seen. With a stop loss of 38.25, one can buy Ultra Cement futures for target price of 4100 to 4200. And among the sell, Kolpal is looking weak. It has seen consistent short pushes. Yesterday we saw shorts to tune of 7%. Has given a weekly breakdown. So it can now test levels of 1035, 1030. One can sell with a stop loss at 1090.
All right, those are some trading ideas on specific stocks. We're just about 30 seconds away from market pre-open. Asia as a pack looks weak. You've got some weak sentiment building around SGX Nifty as well, which is down about 0.5% currently. SGX at 10,550. For the rest of Asia, Nikkei is down about 0.8%. Hang Seng is down closer to 0.5%. Yesterday's close of 10,600 was breached. Whether or not we take down those levels or before that we see a bounce back like Rahul and Gaurav highlighted, every rally from here seems to be something that could be sold into. That's the Nifty pre-open ticks on your screen. 0.5%, more than half actually. Now down on the Nifty Sensex though, slightly more divergent. These prices will cool off. So at this juncture, it's interesting to see what's happening on individual stocks and specific to the oil marketing space. Because yesterday was a complete bloodbath for most of these names. Today doesn't seem to be any different at pre-open at least. So the first top 4 stocks are all from the oil and gas space. HPCL, BPCL, Indian Oil and ONGC. 10% apiece for each of them. Whether or not this should probably cool off and come off, but we'll wait and watch. IndianOpen Bank is the next one in line post the cuts in the oil and gas space. That's down 5.5%. GAIL is down 3.5%. Reliance Industries, after that big 6% knock yesterday, pre-open indicates that 1100 is breached. The stock's down about 3.5%. Bharti Airtel, Bajaj Auto, HCL Tech, Sun Pharma are some of the other losers in trade. You have a handful of gainers as well. Coal India is up, and it's showing even 9%, 7% uptick for Coal India. Axis Bank is up 1.5%. M&M, Titan, and Yes Bank, seems to have moved over the last few days at least. Seems to be fairly okay for itself.
Your fizz gone out of Jet Airways, by the way. The pre-open session seems to suggest a downside, but frankly, just dominating the screens are the OMCs, ONGC. Those are the 4 names that you need to watch out for. Somewhere I'm also seeing a Mindtree, but that's all over the place, showing a downtick. And remember, IT for the last 2 or 3 sessions has been showing some signs of corrections as well. Is there any green on the screen? Let me just try and see if there are stocks at the broader end of the spectrum might be doing okay. Well, maybe some sugar names here and there. Amara Raja showing an unnatural uptick. No, not really. A couple of stocks in news. While Titan is one, Delta Corp, a large brokerage upgrade. Cadila, some updates on the checks from the US FDA and the EIR that they've gotten should come up on your screen as well. Well, about a 4% uptick on Cadila in the first couple of minutes. Let's wait and watch what happens there. The currency and the bond yield should come up. Very important day ahead of the policy. Let's see how we're settling down for the rupee and the bond yields. Currency 73.56, flattish in the session today, which is actually not bad. The last few days we've been really badly bruised. So this on open itself.
Yesterday's low was I think 73.81. So
yeah, so it's not bad. About a flattish start. And the bond yields, the 10-year 8.11 yesterday, 8.13 currently. So this too is a very flattish start ahead of the policy. Not too much. Okay, now before we move any further and get back to our guests, let's head over to Goa, not literally but figuratively, wherein Jayesh Khilnani is having a good time at the 4-day Investors Carnival, which kicks off from today. And Jayesh, I think the mood must be somber, but based on the conversations that you've had, what can we expect from the carnival over the next 3 days?
Neeraj, you can see in the backdrop, the sea is as calm as can be, not just like what the market is right now, but over the next 4 days, we will be getting you a live coverage of the second edition of the Investors Carnival, where you can catch the likes of key speakers like Mr. Ashish Chugh, Mr. Madhusudan Kela, Mr. Jatin Khemani, and Mr. Safir Anand as well. We've lined up a host of speakers who will be actually participating and taking investors through what the strategy should be, what the philosophy should be, and what style of investment should be adopted given what the current market condition is at the moment. But we'll be kickstarting this event in an hour from now, and you can stay tuned into the live coverage that we will be getting you through the sessions.
Okay, Jayesh, thanks so much. Looking forward to hearing some interesting conversations around the markets and some feedback from participants as well. I'm sure you'll get us all of that. But thanks for joining in right now. That's Jayesh Khilani from the Investors Carnival at Goa. 3 days. Boy, I tell you, the mood must be very, very somber.
You're going to be joining in soon.
I'll go tonight and over the weekend we'll be there as well. So looking forward to some interesting conversations from a whole host of experts. Yeah. Let's wait and watch what happens there. Okay, the Nifty bank, the Nifty now is looking like, in the first 4 minutes, looking like starting off about 0.75% in the red. Not the best of starts. Just one more trade update really before I ask a question to Girish. And Rahul, interesting that you're telling your clients to go out and buy 24,000 strike put option. What's the conversation around the banking stocks like right in the morning meets?
I think what we've seen interestingly is that majorly what seen the damages in the private sector banks, and I think which might continue still. So all the large caps, heavyweights like like of your HDFC Bank, after a long time we saw unwinding and fresh shorts built up. Then obviously Axis we saw unwinding in the longs, and obviously earlier we discussed that Indus has been showing a weakness on it. Kotak again has fallen 30% from that. So I think all the stocks have entered into, which are the Nifty heavyweight, bank Nifty heavyweights have entered into a negative zone. So I feel that the fresh shorts might be built up from the current levels. The best way to play in such volatile is to go long on the bank Nifty puts. So I think 24,000 puts for the 11th October expiry, I've been recommending to buy it from the current levels.
All right. That's the bank Nifty, and slightly more amount of downside actually on the bank Nifty towards 24,000. Let's talk some stocks in some sectors as well. And Girish, you were talking about your call on Jamna Auto. Could you highlight that for us? Why do you like it?
Yeah, so we think that, so Jamna Auto is the auto ancillary play focused on the CV space. So we like the CV space, the end market, so to speak, because we think that while there are other parts of the auto market which have shown fairly tepid growth, the CV space has shown fairly strong growth, and we think it can continue for a couple of years. FY19 and even FY20, we think that FY20 could be even stronger than FY19 because of the Euro 6 norms that are going to come through, which is going to lead to some pre-buying that's going to happen in FY20. So we're fairly bullish on the CV space, and this is an ancillary play to the CV space, and in the leaf spring component that it sells to the CV space, it's got some 70% market share. We think that growth can be upwards of 17-18% for this company for the next couple of years, or probably even longer than that. And there could be some margin expansion because a couple of things. One is that the OEM to replacement market mix, it's shifting more towards replacement market. Second aspect is that within the OEM space, it is catering to the higher end trucks, where it's getting higher ASPs and higher margins. So it's better. The components that it's selling is of a higher variety, is the way I look at it. So that is broadly the picture on Jamna Auto, that it's addressing a market segment on the auto side which is going to see fairly robust growth over the next 2-3 years. And within that, it could probably outperform the CV space because it's addressing replacement market. It is going to go out and address the export market and stuff like that. So broadly, that's the story. The return ratio has been very good, upwards of some 30-35% for the last many years, and we think it can continue. And margins have been 14-15%. We think there's going to be slight upward trajectory on the margins because of the revenue mix change that we're going to see. So that's broadly the But again, it's a small cap stock if you look from a mutual fund perspective, because for them the mid cap is between 10,000 crores and 30,000 crores. So this falls not even in the 10,000 crore variety. So it's in the small cap space. So it's individual investors who need to probably take a look at this stock, potential to become a mid cap over a period of time. But sit on it, it could potentially become one.
Interesting, but no need to buy right now. You can buy it in dips as well.
Yeah, it could. It could. I mean, obviously there could be. I mean, if market corrects, I'm pretty sure bets are off on quite a lot of the stocks.
Okay, are bets off on IT as well? And again, the question mark would be that is this correction giving somebody a chance to buy, or would you believe that there could be some more downsides?
See, I think they would see potential absolute downsides possibility, yes, but relative. It's all about relative performance. I would think relatively they could outperform. Now, I think that outperformance is not going to come from underlying revenue growth, your dollar revenue growth or constant currency growth. I think that's largely priced in as we speak. Because for FY 19 itself, except for TCS in the tier 1 companies, none of the other companies have really surprised. So the year started, 2018 started with some great deal of optimism about pickup in revenue growth across the board for a lot of the tier 1 IT companies. I've not seen that. I've only seen it for TCS. Having said that, I mean, obviously rupee has been a big help. We started the year assuming rupee would be like 66 to the dollar. Now we are at something like 77 to the dollar in FY 20 and 79 in FY 21. That's what my economist tells me. So that is going to be a big help. Second is institutional positioning. I think both DIs and FIs are still something like 350 to 400 basis points underweight the sector versus the benchmark. So that I think, and also if you look at the earnings perspective, you might probably see Nifty earnings correct. While there could be a bounce back in corporate banks, the other sectors could probably see some earnings being shaved. Whereas IT could be one sector where you could actually see some earnings expansion because of rupee. I don't think the consensus is building in the kind of rupee numbers that I've talked about. So once that gets built, in my senses, there could be some rupee related earnings revisions upwards that may potentially. So these are 3-4 points which could probably keep the IT sector up from a tactical perspective. Yeah. So if you look from a growth standpoint, I don't think it's still there. My sense is TCS probably may regress back to the 6-7-8% kind of growth next year versus the 10-11% growth it may show in FY19. Because I don't think it's got any large, I mean, unless it gets some big orders like it did in the beginning of this year, calendar year, or in late 2017. Unless it gets that, I don't see it growing at the high single digit or low teens kind of a low double-digit kind of number that it showed.
Which is a valid point, because what's the investment rationale or the investment case for these companies with single-digit growth?
So, see, the thing is about cash flows. People have all been saying that these are companies with great cash flows, return ratios are great. There is also a situation where they're buying back stock. So there is a capital return, both from a dividend perspective as well as from a buyback perspective. So these are all points which have kind of buoyed these stocks. Obviously, INR is the biggest driver right now. So underlying business, I would probably think is a bit suspect. And one of the interesting data points that from Bloomberg, your own database, I think one of the key things that I find is that the capex in S&P 500 and stock 600 stocks is probably at its best in 2018. And it's kind of going to come off going forward. US, I can understand, it's probably to do with the tax cuts that Mr. Trump has kind of brought in. I'm not sure what's happening in Europe specifically, but I think that rising capex is kind of lifting up the sector in one sense in terms of growth. So there you are. So I think relatively it may outperform, but absolutely, I don't know, in an absolute sense, there could be some downside.
Some downsides. Okay, hold that thought, Girish. Minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. First up, Titan's Q2 update says that the shine has returned to the jewelry segment after a relatively softer growth in Q1. Watches witnessed growth across channels. All in all, the company says consumer sentiment indicates sense of optimism.
From the financial space, LIC makes its move with an open offer for 26% stake in IDBI Bank. The offer comes in at 61.73 rupees per share after IDBI's board approved proposal for issuance of preferential shares earlier yesterday. LIC will shell out nearly 12,600 crores for the stake.
Regulatory relief for Cadila Healthcare. US FDA inspected the biologics managing facility at Ahmedabad and the audit was completed with 0 observations.
UBS has initiated coverage with a buy on India's only listed casino operator, Delta Corp. The price target has been set at 310 rupees per share. The brokerage says the high entry barriers in the sector should give the incumbent a lot of scope for growth.
And in other key brokerage calls for you, brokerages turn negative on oil marketing companies after government moves to cut fuel prices by 2.5 rupees per litre. On the other hand, they turn positive on ICICI Bank after Chanda Kocher's resignation. Signals an end to the leadership confusion.
And lastly, United Spirits may dispose some of its surplus assets to repay its debt.
Well, those are a few stocks that you need to keep a watch out for. Before we thank our technical experts and at least thank Rahul, but top calls from both our experts. Gautam would request you to just stay on for a comment post-open too. But Rahul, if you were to bet on one stock for the day today or one trade for the day today, which one would that be?
I think Titan obviously looks, as we've discussed, we've also discussed in our morning meets, and we feel that the optimism is building up back in the jewelry segment as well as in the watches segment. So I think Titan is one stock I think one should look at buying with a stop loss of 750 and target of 840 in near term.
All right. What about you, Gaurav? Your top call?
It would be a Ludex Cement and a stock bouncing from such a crucial level, and that with the short covering is a positive sign. So for me, Ludex Cement would be the one stock to watch out for.
Rahul, before we thank you, just quick comment. What downside levels are you watching for BP, HP, IOC? Very quick, 20 seconds.
I think OMC, what we believe is, I think obviously the negativism entire space. So I think still another 10 to 15% minimum. And I think the most important thing to understand is that the sector will take some more time. So we are back into the days something like 2000 and 2004, 5 what we were, and this stock kept on derating because of this thing. So if this absorbs which has come in, so I think more unwinding, more sense in from here. So I think another 15% downside from here looks very likely in all the stocks.
Okay, Rahul, leave it at that. Thanks so much for joining in today and giving us your thoughts. That's the OMCs, and we'll start off bleeding on open. This is the market open. We'll start off with a fair bit of red, about 1% already for the Nifty. The Nifty Bank, second in a trot, is not falling as much, so the Nifty fall being led obviously by the oil and gas names. Just a very quick mention of the mid caps and the small caps before we get in the heat map. Some pain on the screen for the mid caps, small caps not starting off with a big bang downside, but this might catch up. But bring up the heat map and look at this space out here. All marketing companies, 15% for IOC, 15 for BPCL, 15 for HPCL, and this might be momentary. IOC now is about 18% lower. These two stocks might follow suit as well. So the pain point continues. This is not necessarily only an earnings revision downtick that is coming in, more a sentiment downtick coming in. IOC now down 19, HPCL 19% as well. BPCL should follow suit. GAIL down about 9%, ONGC down about 8%, Reliance is down only 2%. I'm using the term only because of the way the others have fallen. Keep in mind, Reliance fell about 6 or 7% in trade yesterday as well, and technology is not being spared. Tech Mahindra is down about a couple of percentage points, ITC about 1.5% as well. What's holding out, if at all? Titan about a couple of percentage points, 2.5%. Bharti, NTPC, well, some defenses out here, but the OMCs are being taken to the cleaners, now settling at 20%, and this may not be it again as well. So keep in mind, all marketing companies right up there. GAIL and ONGC are down 10% as well. It's really all about what's happening to the oil and gas space. And despite these cuts, by the way, the Sensex is not down dramatically. It's just about 1%. The Nifty Bank about 0.5%. Clearly shows that banking stocks are not falling as much. Just a couple of trends that I want to spot really. You can't go beyond oil and gas on open right now, and BP, HP, IOC, look at these gashes. IOC is down 24%. BP and HP momentarily at that circuit levels, which will open up very shortly, and you could see some more downsides for these stocks. Yeah, BPC had already started, now 22%. I'm not saying this is it and this will continue, but clearly it shows the hand of the market right now. All marketing companies right up there getting clobbered out of shape, quite frankly. Well, can I look at some positives? Maybe a couple of mid-cap names. Just want to highlight a couple of stocks in news, and all clear for Cadila. At least no observations. The stock marginally in the green. Delta Corp, a stiff target from UBS. Is that reacting? Let's pull that one up. Well, about 3% higher for now. Let's wait and watch how long this lasts. But Devina, all about the OMCs. Though must say the Nifty Bank is putting up a brave face.
The last few days, actually, the PSU banks have somewhat managed to hold ground versus the private sector banks, but I'll come to that in a bit. But like we've been highlighting, and it's the oil and gas pack that's bearing the major brunt, of market pessimism in today's session. You've got an Oil India also, which is down about 10% in trade right now. Following suit, and MRPL is down 10% as well from the oil and gas pack. Chennai Petro is down 7.5%. So you pinpoint anything in this space, and that is giving you cuts in excess of 5 to 6% apiece. That too at the lower end of the range. Other stocks, Engineers India is down 5%. You've got the likes of an IGL, which is down 4% from the IT pack. A Hexaware is down about 3.5%. Jet Airways pre-open showed you a 9% downtick, which sort of settled. Now it's down about 3.5% at open. Aban Offshore, ILNFS Transport. Should pull up the ILNFS group stocks as well. So ILNFS Investment Managers, ILNFS Transport, the other ones as well. All these stocks have had a fairly rough last few days. ILNFS Engineering, in fact, is open positive by about 9% in trade right now. Petronet LNG is down 2%. Imami is down 2%. The likes of Godrej Consumer 2.5% lower. Chennai Petro also lower. So 1:2 right now on the NSE in terms of the advanced decline ratio at the start of trade, but that most likely will worsen. But nonetheless, the Nifty and the Sensex both holding with cuts of closer to 1% apiece.
Futures are trading at a small premium though, about a 100-point premium to spot right now. Just opening thoughts, bring up the Nifty futures plate as well, but opening thoughts from Gaurav Bisa before we thank him. Gaurav, how are you looking at the open? The banks haven't corrected as much. The Nifty futures trading at a 100-point premium to the spot. What is your opening observation?
I agree. We just spoke about PSU banks being relatively stable. So as long as 2700 spot level is held on PSU bank index, we can see some more upside in them. And as far as bank Nifty index is concerned, there's a good amount of ratios at 850. If we sustain the levels of 850, I expect a 150-200-point bounce coming today itself. So I would be positive. Majorly Nifty is down because of sentiments. OMCs, ONGC, AL, these Nifty names are down 10, 15, 20% even more. So I would say that let the market stabilize and take a portion. For Bank Nifty, if it sustains levels of 24,050 spot, buying a call option would make really good sense.
Thanks, Gaurav. Really appreciate your time. Thanks for being with us today. Just one final thought, Girish. You mentioned about autos and you being disappointed out there. Some of those with the numbers, but some of those names have fallen quite a lot already. The Aishers and the Marutis of the world. What would your message be to your clients?
So within the pack, as I mentioned, we're positive on the CV cycle. So Ashok Leyland is one of the stocks that we've been pushing. We have a price target of about 152. So I think probably sub 120 right now. So that's a stock that one can look at. And the other stock we have a fairly bullish call on from a medium-term perspective is Aisha. Aisha has come off from 36,000 levels to about 22,000 levels. So my auto analyst believes that from a medium-term perspective, that's one stock which can deliver you the best volume growth on a CAGR basis. He's talking about something like 13-14% kind of CAGR in volumes over the medium term. So that's a stock which you can potentially look at, but obviously you need to have a slightly longer term investment horizon on some of these stocks, is the way I look at it.
All right. Girish, really appreciate you taking out the time. Thanks so very much for joining us and sharing your views with us here on the show. So the Nifty has come up a bit and the premium also has contracted. Yesterday's premium closed at about 32 points. It was about closer to 90 points. Now it's come off again, closer to 47 odd points. Premium Nifty has come back up, closer to about 10,529. Let's bring in Gautam Chhaochharia. He's the ED and Head of India Research at UBS. He's joining us right now. Gautam, pleasure chatting with you and good morning to you. The last few days have been, turbulent in the sense that we've been getting cues from across the globe or what's been happening in emerging markets, what's been happening to our own markets. Little bit of skepticism coming in there in terms of working fresh money. What's the call that you take right now with regards to the setup of the market?
So set up the market in terms of narrative and data points has obviously turned negative compared to say a few months back. A few months back there was a valuation worry, but now not just valuation but the broader narrative has also turned negative. And just to talk about valuations a bit, despite the correction we have seen, our view still remains that the risk reward is unattractive. The markets have corrected from very expensive valuations to less expensive valuations. The markets are still expensive. It's not at a level where we would say, okay, markets have derated sharply and therefore looking attractive on valuations. We are still some distance away from that.
Gautam, good morning. Neeraj here. I remember one comment a few months back when we were into FY18, wherein you had spoken about how you believe that the earnings growth in the current year could be 13-14% and not the heady 20%, if I'm not wrong. Have you scaled up or scaled down or revised your earnings estimates for the year, keeping in mind the sharp fall in the currency and the resultant impairment or forex losses that it can bring? And therefore, to your mind, what is the current multiple that we might be trading at for the indices, and how much can we or should we fall down to?
So we haven't scaled or changed the numbers at all. We have kept it at a 13% number for fiscal year 19, while the street is still at 20% plus. So we will still see earnings cuts by the street. So if you look at street estimates for fiscal 19-20, markets will be trading at around 17.5 times. If you look at our top-down estimates, then the market will be trading at around 19.5 times, possibly 19 times now after the correction. The interesting point to highlight here is that for the currency perspective, the depreciation currency doesn't necessarily hurt earnings so much at an aggregate Nifty level, because many businesses and companies benefit in terms of translated earnings. You look at IT, pharma, metals, etc. So it's not necessarily bad. In fact, the sensitivity we had done is that depreciation of currency for a Nifty specifically actually is accretive to earnings. Now, the big thing which we are still not sure of at this stage is the sharp depreciation which we have seen till now. Does it lead to a slowdown in the economy more than what we have seen, specifically along with the oil price being where they are, and government trying to cut oil prices and therefore possibly see some cut in spending in second half to meet its fiscal targets. So will it lead to a further slowdown of the macro? That's something which is difficult to fathom or forecast right now. But otherwise, we won't be changing our top-down forecast of 13% because of the currency, because that doesn't necessarily hurt.
No, but, okay, so then the follow-up to that is, so therefore, if that 13% earnings growth or whatever the number of 455, 450 odd of the last year EPS, where does, to your mind, that leave the P multiples currently, and what levels should we ideally trade at, keeping in mind the macro concerns?
So look, in very simple terms, over the last 4 years odd, India has re-rated from a 13-14 PE market to a 18-20 PE market over the last few years. That's been, in very simple terms, been because of the political stability and reform and confidence around Mr. Modi, and also because of the easy liquidity which India had, which showed up in low interest rates, strong flows to debt mutual funds, strong flow to equity mutual funds, which helped valuations go up. Now, the second element of the liquidity environment has definitely changed. India has moved away from a benign liquidity to a tighter liquidity environment. This happened a few months back. It was showing up in stress points in the yield and the debt markets a little bit. It kind of came as a shock to equity markets when we saw ILFS, the one housing, all those incidents play out. So, and this is not going to change. It's not that India will have a liquidity environment which is going to be benign in a hurry, because the drivers of easy liquidity is behind us. India has moved from BOP surplus to BOP deficit. Credit growth is recovering and not being very slow like last 3-4 years. Demonetization benefit is behind us, and even RBI is no longer running a very accommodative policy. They are at best running a neutralish policy. So the liquidity environment is now changed for the next couple of years, looks like. And in that context, to have the same valuation multiples for the market of 19-20 times seems unreasonable. The best case in our view in that environment is 18 times. That's the best case. And even if you assume that of 18 times, and if you assume more realistic estimates, then the fair value for Nifty is around 10,500, which is broadly where the markets are now corrected to. So, and ideally you should buy with some kind of buffer and lower than fair value. So we still some time away or distance away before the market looks attractive on risk-reward basis.
Gautam, I want your opinion on the potential risks that the 4 Cs have: the credit market, the currency, the crude, the CAD. These are the 4 Cs that right now are plaguing in on sentiment for the equity markets. how much more of this, is the added negative that you see from this?
So look, these are all stress points, definitely, no doubt. But India is nowhere near 12, 13. When you talk about crude, CAD or currency, it's not as bad as 12, 13. It's definitely not as good as last 3 years. But India is not going to be a fragile 3 or a fragile 5 like 12, 13, because even with oil at 85, India is not looking at being that kind of economy, because apart from crude and apart from CAD, to also remember that India's inflation and fiscal are structurally much, much better. So these are stress points, but nothing to create panic in my view. The credit side locally, India has kind of now been broadly digested the last 3, 4, 5 years of NPL cycle, and that is a big number. And one of the things we have been debating and talking to our clients is what we have seen with ILFS, etc., all these events for the last 3, 4 weeks. Is it just a liquidity squeeze, or is it a big credit crunch also? So our base case is largely a liquidity squeeze, but sometimes what happens is prolonged liquidity squeeze also drives credit shocks, specifically in wholesale funded institutions, and when a big part of your banking system or credit system has that exposure. That's something which we need to track for. ILFS in itself, if you look at the size of the book, etc., while it is again a stress point, but it doesn't really lead us to suspect that we are at the beginning of a prolonged credit shock event again, like we saw over the last 4, 5 years from an NPL cycle. That seems unlikely given the size of ILFL. Obviously, it will put stress and some marginal cuts here and there for specific banks, etc. But it's not a systemic issue at this stage. So at this stage, our base case is yes, these are all stress points. The narrative has changed definitely, but India is nowhere near what we saw in 12, 13. For the markets, obviously the big difference is that now the markets are trading at very high multiples. So the starting point of the markets are not good, and that's what is worrying from a market narrative perspective, that these stress points are coming at levels which are not pricing that in. The levels are priced to perfection for the market. So therefore, we still see scope for further downside for the markets. The risk reward is still not attractive.
From a fund flow point of view, we just had recent data points talking about mutual funds asset base, which have actually gone up 14% on a year-on-year basis, driven by participation from retail investors. On the flip side, FIIs have been selling almost on a daily basis in the last 3 or 4 trading sessions. I think in the last 3 sessions itself, closer to about 6,000 odd crores have moved out from the FII desk, from equities. How would you read into this divergence, and do you see the retail investor participation being a silver lining, or that's not that consequential in nature?
So that's been one of the key underpinnings of Indian markets having re-rated and being very, very resilient over the last 3, 4 years. It's primarily retail flows into mutual funds, into equity mutual funds. And that, in our view, is also vulnerable. What we have already seen over the last couple of months is the non-SIP part of equity mutual fund flows have dried up, while the SIP part is still holding steady. But the second derivative of SIP is also turned, in the sense that SIPs have stopped growing over the last few months. For the last 4, 5 years, they were growing every month. But for the last few months, they've stopped growing. And if the markets remain where they are, or even correct a little bit more, then the SIPs would also be vulnerable in our view. And this is backed by our evidence lab survey of households, which to us suggests that the SIP is not necessarily a very well entrenched behavioral trait yet for Indian households. They would withdraw or stop allocation to SIPs if they see returns turn negative.
Talking about commodities as a play on the equities, the underlying for play on equities. So the oil and gas basket, the metal space, you've got a lot of interest that was there in the metal spec up until some time ago. Prices of base metals have been rising up, aluminum prices have been going up sharply. Is there a play on commodities per se?
So we are neutral metals and mining, while they would benefit from the currency depreciation in the short term. But you have to also remember what the stocks are pricing in. The stocks are pricing in not just volume growth locally, but also EBITDA per ton to go up further, which means they're pricing in further strengthening of global prices, which in the context of trade war is not a safe assumption to make. So it ultimately will depend a lot on how the trade war scenario plays out. But a full-blown trade war is definitely bearish for commodities.
Are you negative on that space then? And the reason also that get extended is that while it may be, I mean, bearish view on commodities might be positive for certain spaces, but it's the commodity-facing companies or the commodity-owning companies which are holding out, the likes of Vedanta and the others. Would then therefore be a call which is negative on those names?
So I won't be negative on the sector. I don't have views on individual names, but I won't be negative on the sector. So it's a more neutralish call in the sense that at least the Indian incumbents will benefit from the currency move, will benefit from some level of continued protection which the government has given, especially in the steel sector. And the Indian companies will also benefit from the local demand and volume growth, which may not be there for many global guys. So I won't be negative per se, but this is not levels where I would recommend being overweight, even despite a cautious market call.
Gautam, brings me to the next question and the biggest burning question really. Across the board, some of your peers have gone out and downgraded oil marketing companies in a meaningful way. Target prices scaled substantially lower. The 10-15% correction yesterday in the oil marketing companies, couple that with the 20% correction today as well. Does this, and all of them trading, I think, near about valuations that have been close to historical values in the recent past, does this price in some of the negatives, or would you believe that it's an uninvestable space right now until there is clarity of whether the government intervention will stay or will go away?
So look, the way the stocks have corrected, they are pricing in the worst of government intervention and them not making any money for a long time. So it's a tough one. So the way I would tell investors is, if you're looking at 3-6 month window of investing, then these stocks will still struggle to do well because after yesterday's announcement, the confidence that the deregulation is here to stay has been clearly shaken up for investors. And until the elections are over, that confidence will be difficult to come back. Even before yesterday's announcement, these stocks have been struggling. They have been derated because markets did worry that despite government's commitment to deregulation and reforms, you never know. When oil goes up, the government might buckle in terms of political heat, which is what exactly happened yesterday. So into the elections, these stocks may struggle to do well, but where they are and what valuations they are definitely attractive from a one-year perspective. So if investors are willing to look at holding these stocks beyond the election period, then these stocks are pricing in the worst already.
On financials, Gautam, what's your take here? And would you bifurcate them into the investable side of financials and probably something that you should stay away from within that space?
So we are underweight non-bank financials, NBFCs. It's not that there's a structural negative call, but definitely for now, stay cautious, because for the next few months and quarters, they will have growth cuts, earnings cuts, etc. And also the liquid environment is going to tighten, and that's going to remain the case. So you have to be selective in the NBFC space. Only individual companies which have the parentage or the track record to be able to still borrow and have the pricing power to pass it on, they should be fine. But even they might face some growth pressures. The retail liability driven private banks, they look very attractive to us, both corporate lenders as well as the non-corporate lenders, because the value of retail liability franchise will start showing up in both earnings as well as in growth rates, which has been not the case for last 3-4 years. So that's a big positive for them. So we remain overweight in them. Some of the stocks have done well, but in our view, the risk reward is still very attractive, keeping in mind the valuations they are.
Just speaking on the private sector banks, you've got a whole host of them which are going to be having a new, a new person at the helm starting next year. What's your sense in terms of whether or not you will see a slight speed bump in the kind of potential most of them have? I mean, you have most of them, Yes Bank, ICICI Bank, Axis Bank, with somebody new taking charge at the helm.
So obviously, depending on the bank and the individual person, there will be some element of stock impact based on how that new person communicates with the street, gives them confidence, lays out the strategy, and does that change lead to any speed bumps, actual speed bumps for the few quarters. So it's a tough one to forecast, but structurally, if we are moving to a tighter liquid environment, many of the private banks who have a retail liability franchise, but the critical thing is they have to have a strong retail liability franchise. They should be fine because the structure, the systemic environment will be very, very favorable to them.
Gautam, did you guys have any coverage on aviation, and have there been any changes to the thought process or the calls on the space?
So we have been underweight on aviation in a portfolio, and still remains so. Those stocks have corrected, but our view is still with oil at 85, the risk reward is still not attractive yet for those stocks. So I can't comment on individual stocks, but as a sector call, we still remain underweight.
Okay, what's the expectation that you have, Gautam, from the RBI today?
So we do expect a hike. Our economist does expect a hike given the macro backdrop. Even though we do acknowledge that the way the inflation etc. is doesn't necessarily need a rate hike per se, but given a lot of the other variables, including macro stability variables in the near term, the narrative, and yesterday's announcement, which also put some risk to either fiscal or growth, you can't rule out the possibility of a rate hike today.
All right. Gautam, thanks very much for joining in. Really appreciate you taking out the time. That's Gautam Chhaochharia of UBS with his views on the market. A quick look at what's been happening on the indices. Before we go ahead and take that break, Nifty is now down about 0.7%, closing in on 10,500. The banks, though, are still holding okay.
Yep, and it's all about OMCs and GAIL and ONGC. But it's also all about the policy. So let's take a break. And on the other side of the break, a conversation on the monetary policy expectations with Taimur Baig of DBS Group.